Tonight isn't about charts. It's about whether the silver price is still reliable. Big drops can hide bigger truths. Silver didn't slide because nobody wants it. It slid because leverage got squeezed. Paper can fall fast while real bars stay scarce. Before we get into it, tap like and subscribe so you catch the next update at the open. If you want clean breakdowns, that's your signal. Over the weekend, pressure is building outside exchanges, slower shipping, tougher inspections, louder calls to diversify risk. Some European ports have reportedly delayed US-bound cargo. There's also chatter that major treasuries are reducing US system exposure. Even partial truth would still mean confidence is shifting. Here's the paradox. Paper prices can drop while physical demand stays firm. That's two markets moving on two different rules. Most silver trading is contracts and netting, not pallets of metal. The structure holds until enough people demand delivery. Then came the jolt. The US dollar index snapped higher, hard. A sudden dollar surge punishes crowded commodity trades. The trigger was a surprise pick for the next Federal Reserve chair, which forced a rapid reprice. Algorithms don't argue, they execute. That's why the move felt like a trap, a push-up, then a waterfall down. In a waterfall, the seller isn't choosing, he's being forced. Silver is one of the most leveraged corners of commodities. When stops hit and margins bite, small moves become big damage. Now add the exchange rulebook because rules can move markets. Margins can be raised with little warning. A margin hike is a cash demand on every futures position. If you can't post it, your broker closes you out. That's why a weekend increase is brutal. It pushes liquidation into Monday. Smaller accounts usually get hit first. People call this rigged, but focus on mechanics, not rage. Mid-game rule shifts thin liquidity and distort pricing. So what do you watch as Asia opens and New York follows? Not one candle, but the stress signals underneath. I'm giving you 5 signs the paper market is losing grip on physical. If several flash together, the system is straining. Number 1, spot versus real premiums. If premiums jump while spot falls, you're seeing a decoupling warning. Premiums rise when replacement supply is uncertain. When in stock turns into call first, spot loses meaning. Number 2, cash settlement. Sweeteners. If more firms offer incentives to settle in cash, metal is the bottleneck. Watch for phrases like alternative settlement or enhanced cash terms. Calm markets don't need those offers. Number 3, lease rates. Leasing is the cost to borrow metal, and spikes usually mean hidden stress. Normal lease rates are boring, stressed ones aren't. A jump suggests lenders are cautious or inventory is tight. Number 4, urgent spreads. If near-month spreads tighten or flip, it can signal immediate scarcity. Spreads are where professionals read the room. They move when inventory and urgency collide. Number 5, warehouse shifts. If deliverable categories shrink, delivery math gets ugly fast. Labels differ, but the idea is simple. Deliverable metal matters most. It exists somewhere is not the same as ready now. Now let's talk about the New York futures complex that anchors Western pricing. It's built for hedging, not mass delivery. Inventory reports split metal into buckets, and only part is committed to delivery. If that committed pool is thin, stress rises. It's a fractional structure, similar to banking. It works when most contracts settle financially. Trouble starts when delivery demand rises even a little. You don't need everyone, just enough to strain the pool. The next test is the coming delivery month. Open interest isn't all delivery, but some of it is. If even a minority stands for bars, ounces add up quickly. That's why the calendar matters more than the headlines. When deliverables look tight, the system tightens back. Expect higher margins, tighter limits, and more risk control talk. That doesn't prove failure, but it does reveal fear. Markets hate disorder, and they try to contain it. Now zoom out. Policy can hit metals indirectly. Tariffs, bottlenecks, and trade friction change costs and flow. A broad import tariff can keep inflation expectations elevated. When purchasing power feels shaky, hard assets get attention. Europe has also discussed tools to answer economic pressure between blocs. An anti-coercion framework can escalate restrictions quickly. Even the option changes planning. Firms diversify suppliers, routes, and settlement channels. And large emerging economies keep pushing non-dollar trade paths. Even small shifts can change reserve behavior. Some proposals include settlement units tied partly to commodities that nudges institutions toward metals as neutral collateral. Don't forget industrial demand. Solar, electronics, medical tech, and grids all consume silver. That demand doesn't pause for headlines. Mix steady industrial pull with investment interest, and inventory becomes the swing factor. Tight inventory equals wild price action. Block 2. So the weekend question is simple. Was this a cleanse or a warning? The answer shows up in the plumbing. Now let's go colder because numbers don't care about vibes. Delivery promises versus deliverable stock is the core ratio. Warehouse data often separates meat specs from committed for delivery. The second figure is the pressure point. When promised ounces tower over deliverables, the market relies on behavior. It needs most players to roll or cash settle. But behavior changes when trust changes. If more holders choose bars over receipts, the illusion shrinks. Even a small delivery percentage can overwhelm the ready pool. Then the venue must source metal, pay up, or persuade cash. Persuasion can be gentle or not. Cash bonuses, tighter limits, and margin hikes are all persuasion tools. There's also the slow drip tactic. Make delivery inconvenient. Delays, paperwork, and operational constraints cool demand quietly. Across the Atlantic, the London market nets huge volume daily. It runs smoothly until physical tightness spreads. Watch the phrase settlement delay, because that's how tightness first appears. When metal is abundant, settlement is boring. Also watch cash alternative, offered to accounts expecting allocated metal. If that becomes normal, confidence takes a hit. Now reconnect leasing, the classic pressure release valve. Now when lenders trust the system, metal can be borrowed and returned. When lease rates jump, that valve narrows. It can mean less spare metal or more fear of non-return. In past crises, funding tightened before headlines caught up. Metals can show the same pattern, just more quietly. So if lease rates and spreads tighten together, treat it as a system signal. It's the market whispering before it shouts. About the banks, dealers run hedges that can look short on paper. The key is whether physical can be sourced if demanded. If too many parties want delivery at once, hedges turn into a supply chase. Then it's about access, not theory. That's when you get violent intraday moves, not because silver changed overnight, but because paper is unwinding mechanically. The dollar rebound matters because it reprices many assets at once. When correlations jump, risk models force selling, and forced selling spreads across books fast. That's how silver can drag broader markets for a few hours. Monday can bring a second wave if margins rose into the weekend. Under-collateralized positions can get flattened early. If that happens, you may see weaker futures but tighter retail supply. That combo is what decoupling looks like. So stay calm and stay structured. Track the 5 signs and separate screen price from street price. If premiums shrink while spot stabilizes, stress may be easing. If premiums expand while spot dumps, stress is migrating physical. Watch refinery lead times and mint backlogs too. Those slow indicators reveal whether supply is catching up. Also, watch industrial procurement behavior. Long-term contracts can quietly pull metal out of spot circulation. Geopolitics matters mainly through logistics and settlement routes. Insurance, shipping, and clearing costs shape availability. If more trade settles outside the dollar, safe gets redefined. Metals can benefit because they're neutral collateral. That doesn't mean a straight line up. Transition periods are messy, and markets can overshoot both ways. Now, the phrase that spooks everyone, force majeure. It's the legal path that can allow cash settlement when delivery is constrained. Even rumors can change behavior instantly. If people fear cash instead of metal, they rush to secure metal sooner. That rush is how stable systems flip into scrambles. It's not everyone. It's enough sophisticated players moving early. And that's why Monday matters. Paper meets physical under fresh rules. The first hour can reveal whether liquidity is deep or thin. If spreads snap wider, lease rates stay high. And premiums climb together, trust is being repriced. That's the signal, not the commentary. If spreads calm, premiums ease, and categories stabilize, the sell-off may have released pressure. Either way, plumbing tells the truth. One more overlooked point. Silver is tiny versus global capital. Small institutional shifts can create outsized moves. A little reallocation from cash and bonds can overwhelm bullion. That's why swings look irrational to outsiders. If you hold physical, understand possession versus promise. Owning metal is different from owning a claim on metal. If you trade paper, understand rulebook risk. Margins, limits, and settlement terms can change faster than sentiment. This isn't a prediction, it's a checklist for awareness. Verify official notices and don't let one headline steer you. Tonight, watch how Asia handles the first wave of liquidity. Thin trading can exaggerate moves and trigger reactions. Then watch New York. Are there real bids or air pockets? Air pockets are where selling turns into a waterfall. If stability returns, spreads tighten and premiums cool. If fractures grow, you'll see delays, stressed inventories, and dealers stepping back. I'll be watching official exchange notices, warehouse updates, and those spread moves as the bell approaches. None of this is advice, just a way to read stress before it hits the headline tape early. I'll track these signals and translate them into plain language. If you want more no-fluff breakdowns, like subscribe to Chili and comment locked in.